time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades is Alan Nuckman, Chief Market Strategist at bullseyeoption.com. Thank you, gentlemen, for being here on this Tuesday. Alan, you're getting crazy. You're picking Twitter to make the trade. Obviously a headliner all year long, well, since the big bid. What do you think here?
Well, I'm purely a price guy, and I know Ben is as well. So if you look at it from a risk-reward standpoint, this group of stocks has something a little bit different than the last time we talked. Last time we talked, I looked at some stocks were bad enough to buy, and I was buying plenty of time for them to base off the bottom. Now that's happened somewhat. We've seen the S&P fill in the gap at 3,900, gap at 4,000. So I'm looking at Twitter, same kind of setup here. It's been trading between 30 and 50 for about 6 months with a $40 pivot. We're hanging around there. A breakout of that range targets 50. It's been trading between 35 and 40 now for 2 months. So we're, this 40 level is really important, but there's a gap up above at 43. So look for that. It's not a matter of if gaps get filled, it's a matter of when.
Tell me more, Alan, when you look at Twitter here, which is at 39.14 right now, as you look at this one, obviously you expect volatility. I mean, when we talk about ad space, when you talk about Elon Musk, I mean, and don't you remember, this was a $71 stock. I mean, I'm not sure it ever goes there again, especially when the buyout price is $54.20.
Well, even 50, if it gets to 50, which is the breakout technical target, we get to 50, this option about doubles in value. So it's about risk reward. My smart money indicator is showing that there could be a short squeeze here, and you've seen a lot of negative sentiment here. So from a risk reward standpoint, from everything that I look at technically, this is a good setup. Now, a lot of things are going to happen, but that's why I follow price, not news. And the fact that it's consolidated at this low level, the volatility has dropped off dramatically, makes it a good option play using my stock substitution strategy, where I have a limited risk option. It's deep in the money. It's like being long from 35. And again, the bottom of this range here has been between 35 and 40. So it's like being long from that bottom. And there are a lot of positives here. Twitter does make money. Twitter is a brand. Obviously it's been beaten up, but don't you want to buy when things are low? That's the way I look at it.
Yeah, I see you have October 21st on that trade. The judge is to start the trial. He may have said this on October 17th, not the 10th of October that was required by Twitter. But so we're going to have a very busy October for Twitter. Ben, your thoughts?
Well, Alan, Nicole, from what I've seen, it's tough to get excited about Twitter. It's very much been range-bound, not really providing directional conviction one way or the other. You guys know I look for a well-defined trend up or down. In this instance, well, here you can see it's mostly been sideways, basically. I'm looking at, 51 to 35. We're talking about since the move, or the move that we saw back in May, the beginning of May, when Twitter sold off. Since then, it's been relatively sideways. That's that lower extreme of the range you're looking at on the right side of the screen there, from 41 to 32. Now, shares this month, we're talking about, again, that 32 low, as I mentioned, that coincides with the lows that we saw back in the end of February. But again, if you look at the larger picture time frame, you're going to see it's mostly sideways, very much contained in a bit of a range. Since the fall of 2013, I did notice that Twitter's really, that's when they IPO'd, if you remember. Twitter's really yet to post any gains. There's a look at the more intermediate kind of hourly time frame. And as I mentioned here, the sharp dip down recently, but right back up and holding out at these levels here. Again, range bound, 41 to 32 is what I'm looking at right now. Bigger picture, 51 to 35. But again, no real lean one way or the other in terms of a directional conviction with anything that's well-defined at this point on multiple time frames.
Right, understood. And so what is your thought here, Alan, as you take a look at some of the charts and some of Ben's thoughts?
Well, I agree that right now it's not doing anything. It's at, it's got that range-bound activity that often is indicator of a impending breakout. So for me, this will be on the right side of the trade if and when it breaks out and fills in that gap at 43. So there's a lot of resistance up here at this 40 level, the 41 level. If it can break through there, then you're going to see some scrambling, and that's what I'm going to take advantage of with this call option on the upside. There's not a whole lot of people that are positive on Twitter. And what usually happens in the market when everybody is leaning in one direction. It's a limited risk play. Again, I say that enough, and it's got plenty of time to see if it's going to shake things up a little bit in Twitter.
Yeah, understood. Okay, let's get here to Cisco Systems, which hit a recent low here, Alan. Your thoughts on this name?
Well, it's got a nice bottom base in place again here, and you're seeing it trade between 30 and 60 for the last 5 years. So 45, where we are right now, is an important midpoint pivot. Now we've gone from 40 to 45, making this bottom base here, and there's also a gap up above. Again, looking for those gaps to get filled, as we saw in the S&P, and we've seen repeatedly. So the play here is a October 40 call. We're trading, what, about 44, 45 right now? So that option is deep in the money, trading for about 550 or so. The break even is $1 higher. It's got 3 months of time. So, we'll look to see where this can go from here. The near-term target is 50. So if you're looking at that 40 call, it's going to about double in value if we the modest 50 level and fill in that gap. Same sort of play.
Understood. Okay. What do you think here, Ben, as you take a look at this Cisco Systems chart? I mean, it really... it's not a beauty, I'll tell you that. Painful to take a look at from the high of 64 down to the lows.
You must have overheard the conversation I was having in the office, Nicole, as I prepared my notes for this one. It is a bit of a mess, to say the least, along the same lines of what we were just talking about as far as Twitter. No real defined trend one way or the other. Not a lot of really well-defined directional conviction after, again, selling off here. Twitter, we mentioned, fell out of bed back in May. This one we've seen coming off and since recently range-bound 46 to 39. Similar pattern in terms of Twitter. Here we're looking at the daily time frame, sideways consolidation, holding on to this lower range. Now, when I stepped back and took a look at the weekly time frame on this one, I did see that we had just sort of found ourselves into the middle of the range that's been established. And again, this one, I have a hard time finding a lean one way or the other in both Twitter or in terms of ticker symbol CSCO, Cisco. It's just not really. There it is. Look, the weekly time frame, the upper extreme around the $63 level. We're looking at the lower extreme around $31, $30, and here we are at 45, basically smack dab in the middle. Just, again, I look for trend. I look for that staircase type pattern one way up or down, and we're just not seeing it here.
Right. So, it's true. Because you look at these, I mean, Alan, what do you think? I mean, it's a tough one.
Right. But if and when it fills that gap, then Ben will say, look, it looks great now. So what I'm doing is I'm putting my chips down with these in-the-money limited risk positions, waiting for, anticipating, confirming that happening by those gaps getting filled in. My expiration break-even's $1 higher. So I'm not trying to be a hero here. I'm just in position for success with these options that have, number one, a high delta, so they're going to act like the stock. So they're the in-the-money options for the stock substitution strategy that are going to have big gains from just modest moves in these stocks. I'm a big believer in the markets here. I like the bottom base that we have in place. If we break above 4,200 in the S&P, then you're really going to see people pay some serious attention. The overall market, let's just remind ourselves, is down 10% in the last year, and it's nearly 10% off the lows. So as bad as people think it is out there, it's not that bad now.
Okay. And then, let me ask you, Alan, before we get to Alcoa, but just the big picture, because today we're waiting on Microsoft and Alphabet, Meta tomorrow, and Amazon and Apple on Thursday. Alan, how do you feel about this group as we're on this tech realm here?
I feel they make a lot of money. All right. There's nothing that changes that. Stocks are a function of earnings. It's that simple. Earnings have continued to grow. Stock prices have dramatically dropped. The PE ratio was down below 16. It was at the 15 handle just 2 weeks ago. Now it's back to 16. But that's 30% off of where it was in January. So stocks, in relative terms, are extremely cheap. Stocks, corporations continue to make exponential amounts of money. So there's no question. It's not like companies are not making money. The big problem with the banks was that they only made, JP Morgan only made $8 billion for the quarter instead of $12 billion. And some companies made $4 billion instead of $6 billion. It's not like companies are losing money. They have pricing power. People have money to spend. There aren't that many fundamental problems in the marketplace right now, except a concern, and people are going to try and talk themselves into a downturn. But we have too many jobs and not enough people, and people are making too much money. That's the problem we have.
I think You know, it's interesting because I think also the language can drive the trade, right? And how, you know, are you feeling more positive or are you feeling more negative? Let's get to Alcoa, Alan. That's your final trade, a name on your radar in the materials. We look really, you know, at aluminum here. Tell me your thoughts on Alcoa, Alan.
Okay, I'm not a fundamental guy, and I know Ben's not either, but 4. Let me just give you the number 4. That's the PE ratio in this stock. This stock is 50% off its highs from March, but it's still up 25% over the year. It's been trading here between 40 and 50 for the last month. Breakout here, target 60. Guess what? There's a gap at 55 to be filled. So I'm looking at the October 40 call. That's trading about 10 right now. It's deep in the money. It's got 3 months of time. And again, I can't state enough, the PE ratio is 4. If we get to 60, this option about doubles in value. So, you know, I don't think the commodities climb is over. We've had a pullback. The Fed got its exact intended result. It knocked down crude. It stabilized interest rates. We're down at 3-month lows as far as the 10-year note yield. So that's a very positive sign that yields are stabilized. We had gas prices, oil prices, commodity prices pull back. That's what we wanted. And guess what? The dollar is significantly off its highs because we've already priced in, you know, all these rate hikes. And so there's not much more squeeze left in the dollar. It may be over for the dollar right now on the upside, and that's a positive for a lot of these commodity companies.
Right. Okay. What do you think here? I mean, does he have something, Ben?
I think out of the 3 right now, this is the one that has the most well-defined trend on the more intermediate on the daily time frames. We're back to the August of 2021 levels. Here you can see after we spiked up into that $98 level, I think it was, how we've come off in swift fashion down to 39. So it's really the right half of that screen that I've got my eye on. You can see a couple different areas of consolidation that formed on the way down. Basically trend environment lower, working our way towards the upper extreme of a range that we've been in over the last few weeks, but not really taking anything out significant to the upside. I understand what Alan's talking about in terms of some of the fundamentals here and the dollar easing off those upper levels. But for me, what I see is the dollar more just consolidating up near these multi-decade highs, not necessarily, again, rejecting the upper level. But in terms of the daily, I mentioned that, Alcoa is back to levels we haven't seen since August of 2021. Now, when I looked at the weekly time frame, it kind of fits in the category in terms of the other 3 that we've seen. There you can see we're right back in the middle of the range, right? You got that upper extreme that we just talked around up and through the $90 level. You've got those lows, if you look from February of 2020 down around $7, and here we are hanging out, as you can see, around 46. For the most part, smack dab in the middle of that range, not really providing much of a lean in terms of the bigger picture weekly, but yeah, the intermediate time frame as we sold off that $91 level, 245-ish here right now, has provided a pretty well-defined trend to the downside after, as you can see, the well-defined run up the trend higher that we had seen. So basically peeling back or taking back about half of those gains off those lows from the beginning of 2020.
I see a few buy ratings here, I'll tell you that. Jefferies, Goldman, BMO, all with buy ratings. Let me see. I think Morgan Stanley seems to be a little more cautious, but they're always more cautious, aren't they, Alan? Final thoughts here on Alcoa.
Well, my final thought is I think the dollar components is going to drive the markets over the next weeks and months, and that could be a positive for stocks and a lot of these commodities. In the fact that, Ben, obviously we're at decade highs in the dollar, but if you look big picture, I've been trading for a long time. Over the last 40 years, the dollar's been between 80 and 120. So we're a little bit above the midpoint of 100. Not really that strong. Yes, we've had a rally because they projected a lot of rate hikes. But some of those projections further out, if you go out to 24, 25, 26, 27s, those are relaxing a bit. So don't look for the dollar. You know, the dollar may have had its last gasp. We'll see. It's consolidating for now. But if the dollar stops going higher, that's very helpful for so many sectors.
Right, understood. And Ben, final thoughts here. I mean, did you want to give me a thought on tech? I did give Alan a thought. We have so many of these names coming up this week.
Well, I'd rather push back on the dollar a little bit, Nicole, if I could,
Okay,
because
go ahead.
The idea being here, I agree with Alan in terms of what we're seeing as far as rates kind of losing the momentum to the upside and the Fed needing to kind of maybe pull back a little bit from some of that aggressive nature. But then I revert and shift my attention over to the euro currency, Alan, the tail that wags that dog oftentimes. And we've got an energy crisis, a political crisis, and you can see the dollar, again, multi-decade highs. And I just look for the strength really coming more from numbers here in the U.S. and the data and the situation here is rather weakness out of Europe and some of the other foreign currencies.
So what you're saying is The dollar's less bad. That's all you're saying. The dollar's less bad.
Yes, the driest towel on the rack, so to say.
All right, Ben.
All right, gentlemen, let's leave it there. What a great, fun Big Three. I appreciate it. We looked at Twitter, Cisco, and Alcoa today. Alan Nuckman, bullseyeoption.com, Ben Lichtenstein. Thank you both very, very much.